Good evening, everyone, and welcome. Stocks continued their somewhat tentative start to 2014 today. It was, as has been the case quite often this year, a classic mixed market. The Dow was the only one of the three major barometers we highlight to end the session with a gain, and that mostly because of positive showings in four of its higher-priced constituents: American Express, Visa, Goldman Sachs, and IBM. Only 8 of the Dow 30 were up today, but that was enough to power the index to its first weekly gain of the year. But don't get giddy. It was only about 0.1%. And so far in 2014, the Dow is off about 0.75%, and the S&P down about 0.5 point. Today's soggy trading was marked by worries over earnings and outlooks. For GE, the concern was manufacturing margins. For Intel, revenue forecast. For UPS, flat-out profit warning. On this Friday, heading into a three-day weekend, the Dow gained 41 points. The Nasdaq today down by 21, and the S&P lost 7.
Let's turn now to Chris Gaffney for his analysis. He's senior market strategist with Everbank. So, Chris, you heard at the top of the program, the saying on Wall Street is as goes January, so goes the year. So should investors be bracing themselves for a down year?
I don't think so. We certainly have had a bit of a rocky start to the year, but it's been a short time period so far, and I think there's a lot of things that will support the market going forward, namely lower interest rates and I think increased consumer confidence.
I was speaking, Chris, earlier this week to a portfolio manager who said, well, we had a market that was up about 30% last year on earnings gains of about 6%. You do the math. This gives me the sense that maybe the market is getting very close to fully valued. What do you think?
We are, I think, more fairly valued right now, maybe slightly overvalued, but it's going to be all about earnings in 2014. I think, Tyler, it's definitely going to be dependent on companies having earnings catch up with those price earnings multiples.
They say on Wall Street that it's all about expectations, and we've gotten a lot of warnings this week, or guidance that's weaker than expected. Should investors just ignore this information? I mean, what are you saying?
Well, you certainly shouldn't ignore it, but I think it's become almost commonplace for companies to give some guidance as far as negative guidance, and then earnings have traditionally been better than expected. Now, we have some people on the desk that always say, the key to happiness is reduced expectations. So perhaps that gives here.
6 of the 10 S&P 500 sectors so far this year are actually in negative territory. But obviously, we've been trading for, 2.5 weeks, and that's not really much of a record to go on. But what sectors do you think will be the most positive contributors to market performance this year, and which will subtract the most?
Well, I think the financial sector obviously is already showing that it's going to be one of the better contributors to the markets going forward in 2014. On the negative side, I think the tech sector, as we've seen already again, we've seen kind of a microcosm of what I think we'll see going forward. Some of the tech sector is certainly going to be a drag.
So, Chris, we have more earnings coming up. Obviously, there's going to be some important economic numbers coming out over the next couple of days. And, what are you looking for? I mean, what are sort of the signposts that are going to guide you in your investment strategy?
Well, again, it's going to be all about the earnings. And again, I think that, we've got a holiday-shortened week next week. The jobs numbers, the weekly jobs data, which has been a bit volatile, we'll get on Thursday, and then the housing numbers at the end of the week. Housing is a key barometer for the U.S. economy, and if the housing can continue to do well, I think that trickles over to consumer spending and consumer confidence, and I think that is what's going to drive the market higher.
All right. Well, thank you so much. Have a great weekend.
Well, thank you.
Chris Gaffney, senior market strategist with Everbank.